stocks fell sharply in late afternoon trading Monday, adding to last week's big losses as volatility continues to rule Wall Street. The Dow Jones Industrial Average fell 223.03 points, or 1.4%, to close at 16,321.07. It was the Dow's fifth straight day of triple-digit moves, and only one of them have been in a positive direction. The blue chip index is at its lowest close since April 15 after suffering its worst three-day sell-off since early August 2011. The Standard & Poor's 500 index dropped 31.39 points, or 1.7%, to 1,874.74. The tech-heavy Nasdaq Composite Index fell 62.58 points, or 1.5%, to 4,213.66. One reason for the late-day sell-off is the fact that the S&P 500 failed to hold its long-term trend line, known as the 200-day moving average, which was 1905 heading into today's trading action. We broke through the 200-day moving average on the S&P 500, and this is a market driven on technicals, or stock chart patterns, says Axel Merck, Chief Investment Officer at Merck Investments. The 200-day moving average has always been hugely important. Quite often, when key market indexes plunge below key support levels, computer trading kicks in, creating a more intense burst of selling. Merck also says the late-day selling action is a sign that momentum traders are getting out of the market. The fast money crowd is selling, says Merck. Investors are jittery over fears that the global economy is getting worse, not better, despite strong growth in the US. There is this nervous cloud hovering over Wall Street that I haven't seen since the S&P ratings downgrade in August 2011 as traders try to assess global economic vulnerabilities, says Todd Sternberger, president at J. Strategia Asset Management. Wall Street will turn its attention to corporate earnings tomorrow, hoping that reports from major banks Citigroup, JP Morgan Chase and Wells Fargo come in strong and CEOs are somewhat upbeat about the future. Earnings season will be more about forward-looking guidance than the top and bottom line numbers, because we should hear if CEOs are bracing for a pessimistic quarter due to an overseas slowdown, Sternberger says. Either way, though, volatility is here to stay, which will likely force passive investors to the sidelines and extend the selling in the short term. Analysts are currently forecasting profit growth of 6.4% for the third quarter, but some Wall Street pros say if the normal beat rate of 3 percentage points occurs again, profit growth could near 10% for the quarter. The market's recent weakness, says Craig Johnson of Piper Jaffray, has a lot to do with so-called market internals, the reality that more stocks are hitting new lows than new highs, and that stock charts for individual stocks and major stock indexes continue to turn down. He's sticking to his year-end target of 2,100 on the S&P 500, however, about 200 points shy of where it is right now. On Friday, the tech-heavy Nasdaq ended the week with its worst weekly losses in 30 months, and the Dow erased all of 2014's gains. While stocks turned in a wildly volatile week last week, it's more a return to normal after a long period of calm, says David Kelly of JP Morgan Funds. He notes that over the past 25 years the average daily change in the S&P 500 has been 0.77%. For the first 9 months of 2014, that number had fallen to 0.49%, he says. Kelly uses an analogy for why recent market moves seem much worse than they actually are. After a quiet summer, a moderate nor'easter feels like a hurricane. European shares ended higher. The DAX of Germany, which has fallen hard into correction territory lately, finished up 0.3%. Hong Kong's Hang Seng Index declined 0.6% and China's Shanghai Composite was down 1%. Stock markets in Japan were closed for a holiday. China's trade grew more strongly than expected in September, possibly easing fears of a deeper slowdown in the world's number 2 economy.